Hello and welcome back to the Note. Well, as you've probably heard by now, yes, the Fed did go through with it. They raised rates. There's a video elsewhere on the site where I'm going to discuss that with Cardiff Garcia and Gillian Tett. For now, I'd like very quickly to go through the mechanics of what happened. The basic point is that the Fed succeeded in its messaging this time around and managed to get this rate rise done with a remarkably calm initial market reaction. The clearest example of that, I think, is this chart here, which shows you the 10-year Treasury yield, arguably the single most important rate anywhere in world markets. This chart starts at 2 o'clock when the announcements came out, and you can see that it was an abnormally calm, boring, quiet afternoon thereafter. After the first few minutes response to the news, this was about as quiet a day as you ever get, as narrow a move as you ever get after a Fed rate decision, a decision that was that momentous. Now, just to point out that this really was momentous, if we take a look at the next chart, we did today, not only did we have a rise in the lower bound of the Fed funds rate for the first time in exactly 7 years, we also had the 2-year Treasury rate, which is very much affected by expectations for short-term interest rates, rise above 1% for the first time in more than 5 years. So there was some move at the short end of the curve, as they say in the jargon. Again, remarkably controlled. One critical point moving forward is whether the Fed is going to be able to keep control of the target rate given the size of its balance sheet. This is all a mechanism that hasn't been tested before at these kinds of levels. As for other markets, you had a similarly remarkably calm reaction in foreign exchange. You had rather a drastic reaction, however, in stocks, where, for reasons I'm not totally clear about, the S&P gained more than 1% during Janet Yellen's press conference. That means that it's now very slightly up for the year, having started the day very slightly down. There are still many days when a Fed move creates a much bigger move than that. Ultimately, if I've any great concern for the future, it's that the Fed hasn't quite listened as closely as it should have done. The most critical point on this is that at the moment, the market sees almost no chance that we're going to get 4 rate hikes next year. There's barely a 20% chance of that. Meanwhile, the median expectation of the Fed's governors, according to the Fed itself in its dot chart, is that we're going to get 4 rate hikes. Somewhere along the line, those two numbers are going to have to converge, and it will create a lot of volatility as we do so. But in terms of a first day's reaction, this was about as calm a reaction as it's possible to imagine, and the Fed must at least feel very happy about that.